You may have heard that investing in an S&P 500 ETF, which is the top 500 companies in the US, is one of the very best investments that you can make. And expert investors do agree on this point.
I think it's the same thing that makes most sense practically all of the time. And that is to consistently buy an S&P 500 low-cost index fund.
So in this video, I am going to explore 5 different variations on the S&P 500. So at their core, all of the 5 ETFs that I'm going to be including in this video are S&P 500 ETFs, but they have been either screened differently or weighted differently, or there has been a focus on a specific sector for all of these ETFs. And that has meant that some of them have had some phenomenal returns, and for some of them, it has changed the weighting away from those magnificent 7 stocks that have brought in a lot of income, but it's also meant that the S&P 500 has become very tech heavy, and obviously some people are concerned that their S&P 500 ETF is too tech heavy. So we're going to need a benchmark for this video, and for this I have chosen Vanguard's VUAG S&P 500 ETF. This is Vanguard's accumulation ETF. With an accumulation ETF, any dividends are reinvested back into your investment rather than being paid out to you. If you were looking for an ETF that paid out dividends, you'd simply be looking for the income generating version, and for this it would be Vanguard's VUSA ETF. So very quickly, let's go through Vanguard's VUAG stats. So 3-year annualized returns are 12.18% and 5-year annualized returns are 14.87%. So really strong 5-year annualized returns. And the ongoing charge for this ETF is really low at 0.07%. But in this video, I am going to share with you a few ETFs that have actually produced higher returns than this S&P 500 ETF, even though they're based on the S&P 500. So the 3-year standard deviation for VUAG is 11.91. Now, a standard deviation is a really good measure of risk and volatility within an ETF. So where all else is the same, what you want to be seeing is lower numbers for that standard deviation, which would indicate lower levels of volatility and risk. So obviously there are just over 500 holdings in Vanguard's VUAG at 506 holdings, and the top 3 are your usual suspects, so Apple, Microsoft and Nvidia. So I'm going to start off this video by including 2 ETFs that I'm personally invested in myself. People are always interested to hear if I hold any of these investments or not. I'm certainly not saying go away and make these investments. That's certainly not what I'm saying. Please do your own research. I'm not giving financial advice in this video. I'm simply sharing with you information. So the next 2 ETFs have had some really strong returns that have both been higher than the S&P 500. I have been invested in these ETFs for a number of years, so have seen those high returns and have been very, very impressed. So the first ETF that I'm going to share with you is S5SD. This is the UBS S&P 500 ESG ETF. So what this ETF is it is the S&P 500, but it has been screened for ESG. Now what ESG stands for is environmental, social and governance. That might be something that really interests you. It also might not be something that interests you. But what interested me was the fact that this ETF has produced higher returns than the standard S&P 500 ETF. The 3-year annualized returns are over 1% higher than the 3-year annualized returns for the standard S&P 500 ETF, and the 5-year annualized returns are almost 1% more, and the fees are only slightly higher. 3-year annualized returns for this ETF are 13.21% when we compare that to VUAG's 3-year annualized returns of 12.18%. 5-year annualized returns are a whopping 15.68%, and the ongoing charge for this ETF is just 0.10%. 3-year standard deviation is 12.10, and the number of equity holdings within this ETF are 316. So you can see that by screening for ESG, which is environmental, social and governance, almost 200 different stocks have been screened out of the S&P 500. The top 3 holdings are the same, Apple, Microsoft and Nvidia, but obviously you have lost some diversity by investing in this ETF. Now that's something that I'm comfortable with. I still think 316 stocks in an ETF is a nice diverse portfolio, and I'm happier to see those higher returns over time. However, you might be more interested in just sticking with a standard S&P 500 ETF, and that would be such a solid investing decision.
Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century, and then since that century has ended, it's more or less doubled again. American business is going to do well.
Okay, so the next ETF that I wanted to share with you has been featured on this channel quite a lot of times. So if you've watched any of my previous videos, you'll probably know what it is. It is the iShares S&P 500 Information Technology Sector ETF. I'll talk through this very quickly, and if you want to skip on to the next ETF, then please do if you've heard about it already. So the reason I'm including this ETF is because it's one I'm invested in personally at the moment and have been for a few years, and it has had phenomenal returns. So 3-year annualized returns for this ETF are 20.66% when we compare that to the 12.18% that we are seeing with a standard S&P 500 ETF. 5-year annualized returns are even higher at 25.30%, so really high. The ongoing charge for this ETF is 0.15%, but what you will notice here is that the standard deviation is much, much higher for this ETF. This is a much more volatile and risky ETF because you are focusing on just information technology stocks within the S&P 500. So the 3-year standard deviation for this ETF is a whopping 19.54 when you compare that to the 3-year standard deviation of Vanguard's S&P 500 ETF, which is just 11.91. So the number of equity holdings within this ETF is just 69. So rather than getting those 500 different stocks, you're getting 69. So the top 3 holdings are Apple, Nvidia and Microsoft, but for the rest of the ETFs that I'm including in this video, you will not see those as the top 3 holdings. So let's move on to some slightly different S&P 500 ETFs now. And for clarity, I'm not invested in any of these S&P 500 ETFs, but I thought they were interesting to include. Okay, so the first ETF has had a whopping 23.13% 3-year annualized returns, which is phenomenal. It's the iShares S&P 500 Energy Sector ETF. The code for it is IESU. So as previously with the S&P 500 Information Technology Sector ETF, what's happened here is the stocks have been screened and they have pulled out all of the energy stocks from the S&P 500. So you're only left with 22 different stocks with this ETF, and it has a very high standard deviation of 26.78. So this is an incredibly volatile and much more risky ETF than simply investing in an S&P 500 ETF. So really do take note of that. This is just energy stocks and it is volatile. So this is an accumulation ETF, which, as I said, means that any dividends are reinvested. 3-year annualized returns are 23.13% and 5-year annualized returns are 13.55%. The ongoing charge is 0.15%, and the top 3 holdings are ExxonMobil Corp, Chevron Corp, and ConocoPhillips. Now, for me personally, if I'm completely honest, this is not an ETF that I would invest in. There are not enough holdings for me to consider this to be a diverse ETF, and that standard deviation for me is personally too high when I'm looking at hopefully lowering levels of risk. But I thought it was really interesting to add, particularly for anyone who's particularly interested in investing in energy stocks but doesn't want to go ahead and invest in single energy stocks and take that risk and wants to invest in energy as a whole within an ETF. This could be an interesting option for you if you're comfortable with that level of volatility. Okay, so the next ETF is another sector screened ETF, and it's the S&P 500 Healthcare Sector ETF. So the code for this is IHCU, and this is an accumulating ETF. 3-year annualized returns are 8.93% and 5-year annualized returns are 11.46%. Ongoing charge is 0.15% and 3-year standard deviation is 11.34, so much lower than the previous energy stocks ETF. And there are 62 holdings within this ETF, of which Eli Lilly & Co is number 1, then United Health Group, and then Johnson & Johnson. So again, with this ETF, this isn't one that I'm invested in, but if you were particularly interested in investing in healthcare stocks, then this could be worth looking into for you. I also was thinking when I was putting this video together that some people are happy to have a much more complex portfolio. I personally am happy sticking with just the ESG screening, but some people might want to collect different sectors from the S&P 500. So you might want to include, say, for example, the information technology one, the energy one, and the health one, and put that together and see how those results compared to a purely S&P 500 ETF. But I like to keep things nice and simple and would personally stick with just the S&P 500 or potentially with an ESG screened one. Okay, and then finally, this is one that I really wanted to include because I have had a few questions about it. It is an equal weighted S&P 500 ETF. Now what this means is that obviously all of the stocks within this ETF are equally weighted. So you are not getting huge amounts of Microsoft and Apple and Nvidia. So this equal weighting means that you are not getting a huge proportion of your investments in those top 10 holdings. So for example, if we take a good look at VUAG, we can see that 34% of the portfolio is made up in those top 10 holdings. Apple, Microsoft and Nvidia holdings alone are making up 6% each for the VUAG ETF. So you can see also that the Magnificent Seven are going to be making up a huge amount of the S&P 500. So if you wanted to have an equal weighted S&P 500, you could consider this option. So this ETF is the Invesco S&P 500 Equal Weight Index, and the code for it is SPEX. It's an accumulating ETF, and as you can see now, let's have a good look at how it's equally weighted. The assets in the top 10 holdings only make up 2.52% of this ETF, and obviously that's much lower than the 34.18% that is made up from the top 10 holdings within a standard S&P 500 ETF. So your top 3 holdings in SPEX are Vistra Corp, Constellation Energy Corp, and Wynn Resorts Limited. Now, yes, this means that you have an equally weighted S&P 500 ETF, but this has had a knock-on impact on the performance of this ETF. So 3-year annualized returns are 7.88%, and when you compare that to the 12.18% that you have seen with Vanguard's VUAG, you can see that that is considerably lower. There are no 5-year annualized returns for this ETF simply because it hasn't been established for 5 years. The ongoing charge is also higher at 0.20%, and 3-year standard deviation is 12.22, which is also higher than a standard S&P 500 ETF. There's still 503 different holdings, but they are obviously equally weighted. Now, for me personally, this isn't an investment that I would choose to make. I would go with the standard S&P 500 ETF, or if I was looking to have a much more diverse portfolio and still have higher returns and have less of Apple, Microsoft and Nvidia and all of those Magnificent Seven stocks, I just choose to invest in a FTSE All World ETF like Vanguard's FTSE All World. The code for that is VWRL, because you are going to be seeing slightly less of Apple, Microsoft and Nvidia. So at the moment, Apple is 4% of that ETF, and Microsoft is 3.98%. So that is what I would do. I personally wouldn't invest in this equally weighted ETF, but it might be something you're really interested in, and if it is, then that's the information for you. Thank you so very much for taking the time to watch this video. Please let me know if you have any comments or questions in the comments down below. I do try to get back to everyone. I hope you have a really lovely day. Bye bye.